Welcome to Salty Investors episode. I'm not even sure. What is it, Tim? 14? Is that what
14.
we're up to?
Yeah.
Jesus. See, just time flies by when you're having fun.
Mm-hmm.
So how are you this week, Tim?
Oh,
What's the
pretty
salt all
good.
about?
Oh, a little bit salty about these poor gas and coal investors. I think they're getting the rough end of the
Ah,
stick again. And for a decade more, they've been told they're, you know, pariahs of the state. We shouldn't be investing in them, and we don't need them, and we're going to wipe you like out, and no one should go into this industry. And anybody who
yeah.
invests in it, holy hell, you're going up against the political class, the banking class,
Mm,
everybody. And now they've come around and said, oh, no, you know, we really need you lot. We really need coal and gas, and oh, your prices are a bit too high. We're going to cap you. So it
mm,
seems a bit hypocritical and just a bit worried where that's going to lead from here. So,
yeah. Oh, a bit of nationalisation never hurt anybody. I mean, that's basically what they're doing. They're basically nationalising the eastern seaboard's gas supply. So, yeah, that doesn't have a history of working out too well. I mean, the real tragedy here is government policy going back, banning the drilling of gas onshore and offshore. I mean, now, did we say this last week? Did I say this last week that I think after 10 years of like banning it and then, oh, let's have an inquiry. Now you can drill offshore in Victoria. Well, a little bit late, though, It reminds me of that. Who was that politician in the UK? There's a quote of him online in 2012 saying, if we build a nuclear power plant, it won't be online until 2022. There's an actual quote out there. Yeah, that would have come in handy, wouldn't it? Would have come in
oh,
handy this year in
who
the
would have
UK.
thought? We couldn't predict the
Yeah,
future, what was going to happen, and won't
the
leave it
real
up to the
tragedy.
market.
Yeah,
We understand what's going on here, and
I know. That's why I sort of laugh at people who think that this government can handle some kind of energy transition. I mean, the government has demonstrated repeatedly they're idiots. The real problem, like I said, we don't have enough gas supply. Yes, I mean, okay, the Ukraine war is obviously playing a role, but I mean, if you'd allowed people to gas, we could be exporting a lot more. Um, and your cat is in rampant agreement by the sounds of
Yeah, he wants to get in and see me, but no, it's not
it.
going to happen. So.
Does he give up?
Yeah,
He
he
give
does
up
give up a
eventually?
little bit. Yeah.
Yeah, that's all
What are
right.
you salty about this week?
Funny thing, this morning actually, I went to Coles. I think Coles should share this information with their shareholders if it's true, which I don't know it is. But I watched as the woman in front of me pushed her way through the self checkout area after being challenged to have a look in her bag. She clearly hadn't paid for some of the items in her bag. Um, the Coles staff, they're very professional. They did their best to try and sort of get her to stop and either pay for it or take the things out of her bag. She didn't. She got out. Then that staff member came over and assisted me, and she said that's the second time this morning. So this was 8:45 in the morning, and she said that there's a policy now that if it's under $100, they just let them go. So I mean, if that is the policy of Coles, and I don't know if it is, that should be disclosed to shareholders, I think,
Yes.
and people should be aware that when they go to Coles, they might run into a few shoplifters just walking off with $100. And if that's the case, maybe that's going to incentivize more people to just walk off with less than $100 worth of stuff. I don't know. What do you think?
Yeah, they're pretty nasty. Like, if I was a Coles shareholder, I'd want to know that, and if
Mm,
this is what's going to happen going forward, that's going to affect the bottom line clearly.
yeah.
And if we're moving into a recession, it's not going to be a small problem. It's going to escalate, a
Yeah.
fair bit here. And I don't know, but I just think it should be disclosed so everyone knows what they're dealing with. We're supposed to have open markets here, so
Yeah.
be interesting to see what comes of this and see if it turns out to be true.
Yeah, it might be one of those cases where they tell their staff that it's not worth getting into an altercation over $100, but I mean, again, it just sends the wrong message. I mean, if you're going to allow that, then more of that's going to happen. I mean, maybe the cops aren't interested because someone made off with some Fruit Loops. I don't know.
Yeah, but
It's
what happens if it's $150? Are they going to confront
yeah,
them and stop them, or
yeah,
what? It should be all outlined, and what's going to happen? Like, yeah, so I don't know. Just concerned for the old coal shareholder here. The margins aren't super wide here, so any
Yeah.
loss. And I know they've taken a hit in COVID. They should have been making bank in COVID, but all the extra, policies that they had to enforce, basically no extra profits, and so they'll be hoping to dig their way out of it, coming out of this COVID, but they've got all these other extra things, and going to a recession, it might not be so rosy to be a coal shareholder.
Oh, well, we'll see. I'm glad that you're such a compassionate man. You're thinking of the coal shareholder, and
Well,
and all
look,
the franking.
well, a lot of the coal shareholder used to be like mum and pup, that used
Well,
to
I
be
think it still is, isn't it?
yeah.
I
So it's
mean,
not
yeah,
like the sophisticated type investor. Like these guys are
yeah,
relying on dividends, and really, it's not like high growth, high risk type investing here. Like this is sort of
yeah,
investing that
yeah. It's one of the
retirees go into.
staples.
Yeah.
Yeah,
So it's not like
fully franked dividends.
yeah, all that sort of stuff. So it's not
Yeah.
like we're mucking around with the high end of the market here. But yeah, also just be interesting to see what happens here and how it rolls out. But I'm just wondering
Well,
if Woolworths got something similar, and IGA and the whole
Aldi.
market. Yep.
Yeah. Yep. Yeah, it'll be interesting to see. I'm currently in touch with Coles through Twitter, so we'll see what they come up with. We'll see if we've got anything to report next week. So, Tim, something happened last night, literally 4 or 5 hours ago in the US. Can you have a guess what it was?
I know there was some big news coming out, but
Big news. Yes, you are correct. The Fed rate. Look, it's not big news though, is it, Tim? Because if you'd been listening to the salty investors, you would have known that the Fed was going to go 50 basis points, because that's what we've been saying for weeks, isn't it?
yep.
We've been saying. They raised. I mean, I love the headlines like highest level in 15 years. Yeah, they're at 4.5%.
It's nothing, isn't it?
It's actually, we're going back to the era before the crazy started, is what we're doing.
Yep.
And so I think the key takeaway here for me was, along with the increase came an indication that officials expect to keep rates higher through next year with no reductions until 2024. Now, of course, we should take any forecast done by central banks with a massive grain of salt. I wouldn't be surprised if they were cutting rates in June,
Oh yeah.
because they've got to be data dependent, and they've got to get the dot plot out and see where the dot plot's at. But the market kind of didn't like that, and this market it's like a child that it's like Homer Simpson. He puts his hand on the stove. Ow, ow, ow! It's just like, dude, stop doing it. It's the market is like, but we thought, aren't we going back to 2% next year? No, apparently not. And the only other thing, they think they said that the terminal rate, again based on dot plots, would be 5.1,
I heard
which
it 4
indicates a couple more rise.
4.9. It actually was decreasing too.
Oh, was it?
Well, depending what you look at. That's the dot plot, but yeah,
Okay.
if you look at the future market, they're sort of saying, it's not actually going to get to 5. So I don't know which one to believe, but
okay. So yeah. Okay. Well, anyway, I think the key is that they're not coming down anytime soon, and so you probably need to bake that in for the next 12 months. And the market didn't really crap itself. I think it's down. It was up 0.5% before, 0.5%
yes.
before the announcement, and it finished down 0.5%. And we really shouldn't pay any attention to those kind of knee-jerk reactions. You got anything to add there, Tim, about the Fed?
I just want to. What do you think? Like they're going to early next year do another 25, and then I think it's just going to plateau. Like they'll plateau for 4 or 5 months, and just wait for everything to settle in. But yeah, what's going to cause them to change? I don't think they're going to get to 5 now. So I just think.
Well, so they're at 4.5. Inflation is what? What is it now? High sixes or low sevens?
Low sevens, yeah. 7.1.
Low sevens.
Yeah.
I mean, you're still negative 2.5%, for Christ's sake. So, like, and I think it's true to say that every bout of inflation that got over 6% wasn't cured until the Fed funds rate was above the inflation rate. Now, obviously, there's two ways that can happen. You can keep hiking, and inflation comes down, or both at the same time, which I assume is going to happen. You're going to get lower and lower year over year prints, and they're going to just creep up to 4.75, maybe 5, and then they're going to sit there for a while because the 70s, the Arthur Burns Fed is an object lesson in not going hard enough. I mean, I know Powell he's at least said that he understands that. He said that he understands that they backed off too early in the 70s on a number of occasions. It wasn't just once. So I think, they'll raise maybe another. I think they don't have a meeting either in January, do they?
I don't think so.
FOMC.
Right.
Yeah. So that's what the RBA and the Fed have going for them. They've got this, let's see how the Christmas period goes through January. They don't have to make any decisions until February. So it's a nice, you should think of this as a pause in some sense. At least it gives them, a little bit of time. And they'll go a couple more. But the idea, as we've been saying on here a lot, the idea that it's just going to come straight back down, the odds of that aren't too high, if history's any guide.
Yep. Yeah. I don't know. Will the market handle, 6 months of it going sideways? Or they're going to have a tantrum here and go, we need, because things will start tighten up. Like, it's going to catch up here. Like, you can see housing's already, slowing right down. And the supply chain thing, no one even talks about that anymore. Like, it's just, I looked at all the ships the other day off China, and there's hardly any parked out there. So obviously supply chains have picked right up. And used cars, I don't know if you saw the numbers, but on the inflation numbers, used car numbers are down like 2.5% on the inflation numbers. So
you mean prices or sales?
Prices, the inflation numbers. So we've just got, the old, housing rent equivalent thing. That's the only thing. We know that's, that's lagged, that's all year over year, all that sort of stuff. So
Well, here's an interesting point. The reality of this is via some, I forget who this was. If you wanted to borrow $500,000 from the bank before all these rate rises, you needed a household income of $122,000. Now you need a household income of $180,000 to borrow $500,000. That's in Australia. Now that's going to put a lot of people out of reach, or they just have to scale back and say, well, I can only borrow 400, so I got to, look at not that brand new apartment or that brand new house, but that one that's 5 years old down the road or whatever, depending on how big their deposit is. So that's definitely a big impediment. Let's have a look at a little more data like that. Before we get to that, I just thought this was interesting. This was tweeted out. I didn't do this. Some guy tweeted it out. Recessionary bear markets tend to bottom when PMIs are well below 50. Unemployment rate has risen by 1.3 percentage points. So that would have to get up to 4.5? What is it, US? You'd have to get up to nearly 5, wouldn't it? Future expected EPS have been revised down 10+%. None of those conditions are met today, and unlikely to be until the second quarter next year, which again, Tim, is what we've been saying. We've been saying this, haven't we? Week after week, pounding the table, and yet the message doesn't get through. But,
I think we could go to sleep for 6 months here and wake up and it'll still be the same story, to a degree, unless it crashes,
I'd be happy to go to sleep for 3 months. I don't know
3
about
months.
6.
True. Yeah, that's probably a bit safer, but something here is going to change. So what's going to go? Unemployment, I think, has definitely got to cross here. It's definitely got to uptick a bit more before we start to see. I don't know.
And the EPS revisions aren't anywhere near 10% yet. So for 2023, the last time we actually put something up about that a couple of weeks ago, they had been revised down 2 to 3%. That's FY23.
Yep.
So they've got a ways to go yet. And as I said, Morgan Stanley was at 195 on the S&P for 2023, which implied something like a 10, bit more than 10% downgrade, because it was at 230 something, I think. Yeah. So still got a way to go there. So again, if history's any guide, probably not. Not there yet. But yeah, just I think I've got slides out of order this week, given what's been happening recently. But I just thought this was, I don't know what your take is. When I saw this, my view was, is this a good country indicator to get out of passive? Like when everybody's storming into passive.
Wait till you see one of my charts. See what they're going into, because it's not equally balanced. It's all market weighted. So the top 10 get a lion's share of that as well. And what does that happen? Doesn't mean they're valued at that sort of number. It's just money pumping in week after week into these high valued companies.
Well, there was a New York Times article, I shared it with you offline, that said that there was no hedge fund active manager that had beaten the index in the last 5 years, was it? And so that, combined with the terrible 2022, and a lot of people might be going, I give up, just stick it in a passive fund, right?
Yep.
I give up. But we might be going into an age where, good active managers can outperform. If you look at the last decade,
why would you?
If you had the index return, you're fine, right?
Yeah. Why take all that risk, all that heartache, and
extra
all the ups
fees
and downs? The drawdowns are just insane. Doesn't matter who you are. You can't be good in all environments compared to the index. But everyone just compares it to the S&P 500. This is what drives me insane. Well, the US dollar is at the highest it's been for a long time. People are saying, has it got peaked there? I know that's dangerous talk, but reversion to the mean must happen there at some stage as well. Like, we can't have US exceptionalism keep going forever here. I remember EM and, Asia, they were all themes, not that long ago. We'll rotate into them a little bit. And if you're just stuck in the US, I know you get exposure to them a little bit from those US companies, but I think it is a good indicator, this, but you've got to pick your active manager, I suppose. Looks like a heap of them are junk. So,
so I just thought that was interesting. That's interesting. So this came from Macro Business, because last week we took a look at how the US consumers had blown through all their excess savings, right? And they're just back to their disposable income. They had a huge burst in disposable income, savings rates went up, and they've blown through that, and now they're just back at the normal level. So this is real household disposable income per capita. You see a spike up there in 2020, and now we've definitely come off the peak and heading down. The more frightening one there, I think, is Australian real wages, heading back to, levels of 15 years ago. So that's got to hurt. Now, the thing about that is you shouldn't get too fixated on real wages, because people have other sources of income. So that it doesn't pick up everything else, right? But it's not like the stock market's been producing wonderful gains this year. So it's got to provide some kind of impediment to consumer spending next year, you would think, combined with higher interest rates. This chart, I think, was even more damning. This is from the government's budget papers, right? This is where it's from. So if you look at that drawdown in real wages index, it's literally back to 2010 levels. Is where they've got it bottoming out in 22 to 23, which is only, that's fiscal, that's just 6 months away, right? And then it nicely turns up. Well, maybe it doesn't nicely turn up like that, because that bit is the forecast, right? that's actually historic. They should have actually coloured that a different colour.
Yes.
Someone doesn't know how to use Excel, maybe. Um, yeah, because that's pretty huge. That's a
Well,
pretty huge thing.
just anecdotally, I've heard miners complaining that, wages haven't really changed in the last decade. You know,
Right.
you can inflation and everything else, and the conditions and the food and everything you get, and you think miners, they're supposed to be, the best blue collar worker in Australia that actually earns some coin.
Yep.
And they're complaining, saying, it's not as good as they're still only getting $40 an hour, and they've got to go through all this extra hassle and fly in, fly out, and comparing it to a decade ago when that similar type of money would go a lot further.
Yeah.
This chart is sort of proving that a little bit. Like, why would you get involved into mining when you can earn that sort of money, in the city? But the problem is what do we export in Australia? Ficking nothing. So I don't know. Like, and we're in a
Gas.
yeah. Well, we did it once. Yeah, we're exporting a lot more. I don't know. It's just this commodity cycle does crash a little bit. And they're already complaining about the wages. Wow, what's it going to be like in a couple of years' time if we go through a hard time? Who's going to be earning the money here? So. And remember, like 30% of their wage goes straight to the government, as taxes. So tax receipts are, all this talk about, getting rid of miners and how terrible they are, and
Well, that's a funny thing, though. I mean, they want to get rid of certain types of miners because if you're pro renewable energy and you're pro the electrification of everything, electric cars, you are massively pro mining because it takes an enormous amount of resources. For example, to build electric cars and to build all the. I don't know if this is true, but I saw someone say the other day that the amount of transmission infrastructure you need for renewable energies is something like 4 times that of traditional. I don't know what that is, but whether maybe it's not 4 times, maybe it's even if it's double, it's still. So if you absolutely love mining, if you're pro renewable, pro electrification of everything, which is it's strange because I see now people who on Twitter now there's this language talked about people who are in favor of fossil fuels as they just call them the polluters. The polluters want, it's like, wait a minute, what, renewable energy, there's no pollution involved, no massive clearing of land, no digging up minerals, none of that happens. It's just a weird way. They often do this. They capture the language and make it sound
demonizing people. I see that now. The Greens and POCOT put in an electrification part of the bill, for the price cap, saying that lowering. So we should be changing away from gas into electrification of things. But like I said, if you haven't got the infrastructure to bring that electricity to the houses, how are you going to switch everyone over from gas stoves to freaking electric? Just.
I don't know about you, but I prefer cooking with gas. Just like electric, I never got used to electric. Just prefer cooking with gas anyway. People prefer gas.
Yeah, but when you don't have a mix and you're just reliant on one thing, that's not
disaster.
Power goes out, or when we get a cyclone, or Australia, who would have thought bushfires or whatever, like
floods.
Yes, Australia, and we're just relying on one source of energy. It's not the most wisest solution. And yes, you could have done that, but you need to start 20 years ago. You can't just turn today and go, oh, I'm going to switch off gas and go to electric everything.
Yeah.
And they were pro-gas.
They'll
pro-gas a dececade ago. All the greenies, let's all go to gas, Now they're all switching their mind. You just can't do these things that quickly. No. Sorry to get off track here a bit.
Watch. No. Anyway, just thought, we keep talking about a wall that the Australian consumer is going to run into. Maybe we won't. Maybe we'll sail through it. Just unscathed. Who knows?
Well, we've got away with it last time. So the GFC didn't really hit Australia. So 30 years is a long time to not get a proper recession. So
yeah. So we are due for one.
Yeah.
Definitely due for
odds.
One. Okay, so this was you got this off Mr. Gundlach, did you?
Yeah, Gunlash. Yeah, like as you can see here, this is just horrendous. Like you're wondering why passive does so well. So passive,
Manama.
yeah. So they call it mana now because of meta, but yeah, like if you're in passive, you know,
Mm,
all the top stocks are weighted that way. So the top 5 or 10 are like 5% of the index, each of them, or 3 or 5. So you're getting a lot of them. When you put in an index fund, most of your money is going in towards these top stocks. Um,
yep.
but that expands the multiples on them. Doesn't mean the underlying value is there. You have got some investors going into them as
Yeah.
well, but if we do get a multiple compression, which normally happens in a recession, I don't think there's been a
Mm,
recession where we haven't got a 15 or a 17 handle on the PE at some stage in it. And so you're thinking, wow, look at these names. Like, it has come down a fair bit, but
yeah.
I could see at least 750, here, for these lot. So it's got another, 20 or 30%, probably 20%, to be honest, is already corrected enough.
Yeah.
But, nifty 50, from those days, that not all everything hangs around forever. Um, Things change over time. So I'm just not sure which
Your
one of these, are going to drop out.
yeah,
Netflix
the
here
nifty
seems to,
nifty 50 was a disaster. I think they were down 70-80% on average, weren't
yeah.
they? By the end of it. Yeah.
But you've watched all those graphs. Go back every 10 years and look at what's the top 10 holdings in the S&P 500. It fluctuates.
Yep. Yep.
Go back 20 years, it was a whole heap of gas and industrials and oil and things like that. And so,
No, that's why I mean financials. Financials were huge just
yes,
before the financial crisis,
yeah.
weren't they? Part of the industry, part of the index. But that's why I keep being suspect about like all these big moat companies, Microsoft, Netflix, Apple in particular.
Mhm.
That all right, great time to buy. These things are off their highs by long. It's like, but yeah, the ones that led the last bull market won't be the ones that lead the next one. And it's like, I
Mhm.
don't know what if it isn't them, I don't know what it's going to be. But that's why I haven't been, I don't know, super keen just to jump back in just
Yeah.
yet
Well, you
on
just look
these
at that
big names.
those multiples there to show, like you don't
Mm.
expand from 2013 all the way up to today. With you know
Yeah,
that's some huge. I know they've got heaps of earnings behind them as well. Those earnings has
yeah,
increased, but well, that's a huge. And you're wondering why you can't beat the index. Like if you weren't in 2 or 3 of them, you're basically toast. Like there's no way that you could beat the index, like unless you
yeah,
um just luck. There's got to be a lot of luck and just magical
yeah,
um active investor. But yeah, if you didn't hug the index here a little bit, like grab 2 or 3 of these names and also, ride them, you're in
yeah.
trouble. Like you're not going to beat it. Like look at that.
I,
Like,
I wonder if we based the chart from say the peak in 2021 and we were sitting here in 2031,
okay.
what that's going to look like then.
Oh yeah.
You know,
Yeah.
what's that going to look like? Right now, you'd have to say that you'd be the MSCI All Country probably looks good from
Yes.
from from 2021 to today. Yeah,
Well, like
I
emerging
wonder what that's going
markets,
to look like.
you know, they're definitely going to come back here. The multiples are super
Mm.
low. There's heaps amount of value in there. It's just what names do you roll into? Like it's just, US dollar is so
ETF,
strong. Yeah, yeah,
some
ETF.
sort of ETF.
Uh,
Yeah,
well, Terry's got rid of his
yeah,
feet one, which was in China and India and stuff. And I thought, oh, that was probably the best
right.
fund he had, but it hasn't performed,
Yep.
as you can see why.
Mm.
But at some point here,
And he gave up. Maybe he
yeah,
gave up too early.
that's if I spoke to him, that's what I'd say. I'd say, hey, you just,
Yeah.
threw in the towel a little bit early. You look at another 10 years and I'm sure it would have been doing well. But yeah,
Mm. All right. Let's move on from Manama. So you've got 12 quality funds and what are the top common holdings? So what are Some are the common holdings the one down the
Yeah,
right hand side there? Is that
on the
is that
right hand
right?
side.
Or yeah.
So I'm like, yeah, man,
Okay, so so 9 of the 12 funds have Visa, for example. Is
yes,
that's what you're saying? Yep.
in their top 20.
Yep.
So I was
Right.
thinking, oh, how could I just simplify this whole thing instead of me trying to pick what I should invest in? I'll just look at what the best in the world. There's probably probably $1 trillion worth of value being invested here. What's the best guys in the world? What are they investing in?
Yep.
And I just thought, oh well, I'll just collate them and find out what's the most frequent ones. So obviously you need to chuck a valuation on top of this, but you can see here there's some names that just keep throwing up. Like you said, Visa, nine out of 12 funds have got it. Even Adobe 5.
Mastercard's not in there.
Yeah, it's number
Oh yeah,
6.
there is. Sorry, yeah, it's number 6. No Apple. No Apple.
No, I don't think so. No, it'd be maybe down lower, but because Terry's just entered it. But yeah, remember Apple wasn't that well liked not that long ago. Like it didn't have, it was a low PE type thing, so it wasn't a high growth type. So we're looking for growth, sustainable growth. The moat type, quality type investment with a high returns on capital. So yeah, I just thought, it'd be very interesting. Like if I just, next week, the market crashed 30%, you just grab a list like this and go, okay, let's just start at the top, do a quick valuation on it and think how good is that moat and hold it for 5 to 10 years. And I'm sure you would do well. Like I'm sure it'd be a pretty good investment. But so then I thought, okay, maybe this isn't concentrated enough. So I thought, oh, well, I'll flick it over and do it based on the top 10. So it's slightly different. That's the next slide. So I did it on the top 10. So this is like only look at their top 10 and wow. You can see Visa still holding their hold. Still 9. So
Mastercard. Yep.
Oh,
hey, geez, 9 all the 9 of them had it in their top 10,
Yeah. And Accenture, the one that you've been having a quick look at. And you got Adobe and ADP, Autodesk, Estee Lauder, and you got one of my ones at FICO, you got, you got a few other ones there, and S&P Global, Moody's in there as well. Yeah, Moody's is right at the top. So, you've got the normal culprits here. We've got a nice condensed list. You're not looking at 3,000 stocks here. So you really, got a concentrated list to go, okay, can I understand these things? Do I actually like them? Do I want to hold them? And can I understand the moat? And what's the moat going to look like in 5 to 10 years' time? So, yeah, I thought I'd use the power of, these billion-dollar investors and see what I could come up with. Yeah.
Yeah. And what are the return? Have you looked at the returns of these guys for the last 10 years or so?
Yeah, well, obviously these guys normally do fairly well. Like,
I know. So I know Poland and Terry Smith and Chris Hone. There's a few that I don't know.
Yeah, so
Jensen, I know.
There's a couple here that I didn't get to put in because they've got under $100 million under AUM, so they're not listed on SEC. So it's too much manual work. But I would, if I was doing this properly, I would some of these other people. But yeah, their returns have been quite good. Obviously.
So did you run out and buy a shitload of Visa then?
Nah, not yet. Because that should get corrected a little bit. But I'm just waiting now. Like, I think it's better to wait. Because like you said, 6 months out, and it's probably a bit long. Something might happen before, but 3 months out, I think it's worth sitting and waiting here a bit. You might get an opportunity to swing at something here. So that's what I'm looking at. Yeah.
Yep. Fair enough. All righty. Have we reached the end of the program? We have too. Yeah. All right. Well, that's some good work there, Tim. Something for the fans to chew over if they've made it this far into podcast number 14, as I'm sure they have. So that's it for us this week, and we will see you next time.